streaming again now. I actually think that there's divine intervention in what's going on in the world today, except not by any God we know, by like a really, really badass God who's really mean or something. It's the only way you can explain how crazy this world has become, practically in the last week, of course. Syria struck a deal with Russia to align themselves with the Kurds, because last week the Kurds were our ally, and now the Syrian army is marching north to the battle to fight Turkey. And we're retreating, of course. So that can only be explained by divine intervention. That cannot be explained by human activity. The absurdity of it all, the fact that my videos keep failing and my computers blow up, are all explained by the same thing. There's something's going on. Let's see. Oh, yeah. So this is 145. Well, effectively, the par value for this is 100. As we'll see when we get to bonds, bonds begin trading at a value of 100, and then the market value takes the value up and the value down, but it's all sort of mean reversion around 100 in the ultra long run, because the bond is issued for a value of 100. It's just a reference price, and they expire, or they are refunded for a value of 100. So they start at 100, they end at 100. They may go above it and below it, but when it's at 145, that's way above, of course, the original par value at which it was issued. And so that means, of course, that interest rate behavior has become very abnormal. So this is a very interesting security to watch and a very interesting security to trade. Although right now it's very unreliable. Now, this is kind of hard to understand. I do ask a question or two about this on the exam, but it's kind of a light question because this is hard to keep straight. Mostly, I say, based upon the terms that are in here, so I'll ask a question maybe about what is a creation unit and the like. But you do have to wonder how these things get into the market. Well, of course, they're first released like a mutual fund is released. They've just dumped so much on the market, and there's demand for it, like on gold. They bought a huge inventory of gold to begin with. Then they issued share certificates that they tried to match to the price of gold, and they sort of filtered them out there such that market arbitrage would sort of push it to the price of gold and got it established, which is what happens on all of them. But what happens if there's a big surge in the demand for the asset per se, independent of the collateral price, or a big collapse in the demand of the asset relative to the collateral price? What if everybody decides that they just want to dump their index mutual fund all of a sudden, or they want to dump gold all of a sudden? What are they going to do about that if X number of shares are outstanding? Now, again, to some extent, up to a point, arbitrage that we're about to describe and is described in the chapter, but is also common sense, is going to keep the prices in alignment, which is to say the market price will be kept close to the NAV, kind of up to the point. But if you have a huge inventory of the asset in circulation and demand has collapsed, eventually they have to withdraw that asset off of the market. So the ETP has to pull it in, and the inventory of shares outstanding has to decline. Now, when these things first appeared, I had wondered whether these markets would be able to do this properly. I'm convinced now that unless there's really a substantial crisis, they actually can, because quite a few of these ETPs have fallen from favor in recent years, and they were wound down successfully by the issuing companies without a crisis. In other words, they issued maybe 30 or 40 million shares of the ETP outstanding. It traded stably. Then the index in question, or the commodity in question, fell out of favor. Demand for the ETP ratcheted back. And you go back and look at the data, and you'll see there's only half as many shares trading as there was 2.5 years ago or so. So they did obviously manage to pull them off as needed, and they can put them back on as needed using this complicated process here. Now, the fund sells blocks of the ETP, like 100,000 shares at a block, and those are called creation units. And they sell those to market makers, specialized market makers, at the NAV. And they say, okay, here you go at the NAV. Now, even though I've never found a reference that says this, I think they actually sell them at a very slight discount. Then the distributors sell their inventory to the market as demand grows. Now, most of these ETPs entered these markets when the markets were rising in value. And so, of course, there is an inventory advantage to holding the asset as you're sort of easing it out onto the market, taking it out of your distribution inventory and letting the general public have it. Because if the price is kind of creeping up, it may be doing so with volatility and bid-ask spreads like everything else does, but if nonetheless it is trending up, you buy a gigantic block of it and then you sort of release it slowly back out to the market. You make inventory profits by virtue of the fact that the price is rising. That's why you don't see these ETPs increasing their inventory very much during stable or declining markets. But when the market does turn to a stable or declining market, then the distribution stops. But of course, that's consistent with supply and demand behavior anyway, so that doesn't really cause much of a problem. The big issue, though, is how do the market makers make profits on this? Now, if you look at the textbooks all say it's on the bid-ask spread. But by my calculation, that's not enough to actually make a profit, in my opinion. So that maybe they do, but I don't think they do. I think it's mostly they're playing the bullish market, they make inventory profits, and then they just don't have that much inventory when the markets turn down, and it's not a problem for them. So they sell off their inventory to the markets as demand grows. The proceeds from the unit sales are invested in collateral. So, for example, interestingly enough, many of them accept if you are a market maker and you say, well, I want to distribute your ETF, what do you take in payment for that right? You say, well, you obviously take cash, and then they distribute the ETF. It's actually not the case. They normally pay in kind for the ETF. So if you're going to be a gold distributor, you pay gold to iShares. And then you get the share certificates to sell to the general public. If you're trading one of the index funds, you actually pass the stock commodity collateral onto the ETP rather than cash, and then you get the ETP to sell to the general public. So this is how, of course, the fund family gets the collateralized asset. They were given the collateralized asset in payment for the ETP. Now, there are probably some exceptions to that. I have to look at every one to figure if they all work that way. But the ones that I've looked at do work that way. And that's kind of interesting. The ETP is required to buy back the creation units if they're being supplied at the NAV. So the market makers have the right to say, I want to sell this back to you at the NAV, within limits on volume, of course, because the NAV has to adjust as the material comes back. So the sort of diagram that we have used over the years kind of looks like this. You've got the ETF, and it creates 150,000 shares of the ETF, and that's called one creation unit. And so they send that to the authorized participant, who's effectively the market maker. The market maker, as I say, sends back not cash, but sends back a so-called creation basket, which is a basket of the very collateral that the ETF is collateralized with. It's very easy to remember in terms of gold. For example, they send gold to them. So that's a great true-false question, right? ETFs, market participants acquire their inventory by giving cash to the ETF fund family? And the answer is no. They don't give cash to them. They give a creation basket to them. So, and then, of course, these sellers sell it to the general public, you and me, and it's out there trading on the market. It seems to me kind of like a clumsy arrangement, but it works very well. So when you read about it, you say, well, that can't possibly work when the markets are volatile and rising and falling. But in fact, it does indeed seem to work. Now, this is the example from the book on how arbitrage is supposed to keep the gold ETF at the correct price. The example in the book is the hack ETF that consists of cybersecurity stocks. So we have two examples of the arbitrage. You say to yourself, okay, the market price is determined by supply and demand, period, like everything else, bid asks, of course. If there's a surge in demand, as represented in higher and higher bid prices, then the market's going to reflect that, of course. It's determined always by the intersection at level Q. The spread between bid and demand is typically fairly narrow, and market orders are coming in, picking off the bid and the ask Q, and limit orders are raising the bid and ask Q up and down. That's what determines the price. Nothing else directly determines the price. But the NAV, which is the value of the commodities held by the fund of the assets, is what it is, and they don't necessarily have to match up, and they won't sometimes match up. Now, if they don't match up, however, as is the case here, if the NAV is for gold is 147.42, if you determine that the NAV is 147.42, and you look and see that the bid and ask is 142.60 and 142.50 for the ETF that holds that inventory in the NAV, then of course you increase your demand for that security sufficiently to where it has market impact to pull the price up. And then you sell off the inventory because you've just made a $5 per share capital gain. So the spread between the NAV and market determined prices is going to be solved either quickly or over a relatively short, very quickly or over a relatively short period of time by market arbitrage. If the price is too low, the market price is too low, that'll be spotted by computers that track this stuff, and the resulting demand will push it up. Now there's not a hedge fund, but a quant trading firm. I can't tell you the name, actually, but it's one that recruits here, and it wasn't the one that was here last week. But they've actually asked me not to say that they do this, so I can't tell you who it is, that does ETP arbitrage on a very aggressive scale. So you say, well, they do this? Yeah, that's exactly what I'm saying. Their computers keep track of all the securities in the various ETPs that they trade against, and of course, obviously, they calculate the NAV themselves. They don't rely upon the every 15-minute publication of the INAV from the site, because you can go to the website and see what the INAV is every 15 minutes. And they arbitrage in and out of this stuff. They trade both the core commodities that the ETP holds, and obviously they trade the ETP. So you say, well, then they do it for gold. And they say, no, they don't do it for gold because gold is never going to be out of alignment because it's too simple, right? Gold has one commodity in it. You can always track what that commodity is. If you actually go to the Spider Gold site, from where I pulled that data down that I opened the lecture with, or the same material for the chapter, you'll see that every second they have the value of their inventory listed there to the penny. It'll be some number, as I had on the opening slide for this show. It'll literally be some number like $12,659,374,218.12. And they'll have a little Unix timestamp right next to it. That's what it was worth, that amount right there. So you can easily track that, and you can see whether the price is different from that NAV value. And when you do, by the way, during the market open, or during the market trading hours, I should say, there is a spread almost all the time. It's usually about 20 or 30 cents, and that's not enough to make any money off of arbitrage. Or maybe that's the point where the arbitrage on a small scale takes place. So what do these guys track at this fund? Well, in the book, I give the example of HACK, which is the cybersecurity tracking ETF that has, I think, in its inventory, according to the book, 56 stocks. But about 15 of those stocks trade in foreign markets at times when our markets are closed, and therefore are trading in our markets when their markets are closed. And so therefore the NAV of that fund is estimated rather than known, because some of the stocks are in closed markets while the others are open. So they specialized in tracking what they estimate to be the NAVs of these more complicated tracking ETFs like HACK, where you have a lot of overseas market presence in the portfolio, and they traded on a fairly small scale in exactly the way that I'm describing here. I don't know if it's profitable any longer. One of the weird things about these algo trades is they work if nobody else is doing it except you. But as soon as a number of trading firms start pursuing the same algo, then the competition squeezes all the profit out of it, and the strategy is no longer valid, which is why they didn't want me to ever say who they are.
But Prabha, regardless of who they are, if you say what they're doing, doesn't that just...
Well, it would be if I was a big player and got a lot of attention, but the only one that ever hears anything that I have to say is about 1/3 of my class. Well, sorry, but you have very little influence at the present time. So, I mean, I have students in my class all the time talking strategy, but the strategy you're talking about are old strategies that are long dead, that were once very profitable. So you got to think up new strategies. And that's literally true, by the way. The dissemination of trading information kills trading itself. The strategy kills itself when enough people know how to do it, in at least some of the trading strategies, of course. They're probably not profitable, but it's not because of me, because others know that this is a possibility. Now, one thing that we learned from the flash crash, which you may recall has not been fully explained. Actually, in the chapter, I think I describe it, Appendix A, has not been fully explained. Nobody's quite sure of what actually happened because it didn't last for very long, is of those stocks, which was a fairly small minority of stocks that went basically to the stub quotes. Most of them were ETFs. And that seems counter-logical if you think about it. Because it could be that General Motors stock could all of a sudden crash and you don't know why, because some terrible thing has happened that's going to result in the bankruptcy of General Motors. I remember when the information was released about Enron, it was truthful information about the true state of their company, the stock completely crashed at the moment of that release because they were lying about what condition they were in. And then when it was discovered that they weren't going to survive, the stock crashed immediately. But one of the ones that we're looking at, is it here that we're looking at? Yeah, IWF is the growth index fund, the iShares Russell Growth Index Fund. It's completely impossible that the collateral went to zero in that fund, and yet the fund itself went to the stub quote, which was 0.0001 at 1447.58 in New York time in the trading day. And so the crash indicates then that a completely irrational act can be triggered off by these computers that are running the algo trades for at least a brief period of time. Now, again, how it happens, basically, no matter how specifically it happens, how generally it happens, is the computers that are running these algo trades all day long hit thresholds that tell them to shut off. You know, they have these safety thresholds based upon who knows what, and they hit a threshold that says stop trading, meaning, in other words, no longer submit any bids or asks. Now, it's on the bid side, of course, where they're going to be shutting off their business because they may want to actually keep their asks going because they may want to get rid of their stock if they can at a good price. And so if a bunch of these computers are triggered into an off condition or a non-trade condition by the same bit of news because they all have similar designs, then, like I say, the bid queue goes black. Right? And that's literally what happened on this day. The bids just disappear, except then for the stub quote. Now remember, the stub quote is actually a quote that a market maker will put in there that's a nonsense quote at a price so absurdly far from the market that they're just making sure that their equipment is running by putting the quote in. You know, so the stub quote, for example, on IWN, when it was trading for $50 a share, was 1% of 1 cent. That was the stub quote. It actually traded at that stub quote because when the queues went black, the stub quotes remained and the stub quotes were traded. Since then, they've outlawed the use of stub quotes for that reason, so that can't happen anymore. But interestingly enough, it happened then. Now, the trouble is You see, the point for this, if you're using this stuff for investing your retirement fund, good Lord, you don't want $650,000 of your retirement fund to do this, right? This is not going to happen on a mutual fund. A mutual fund is determined by the NAV at the end of the day, but it did happen for the ETPs. And so you say, well, yeah, but it recovered because obviously the collateral was held. What if you had safety stops on your trades, as a lot of people do? Remember, a stop limit order is one to protect you in the event of a sudden market downturn. So you've got the stop, let's say, just lagging by a computer, which you can actually do on TWS. You don't need your own computer to do this. You can program the interfaces on these more complicated trading platforms like TWS on Interactive Brokers or Thinkorswim on TD Ameritrade. Say you have your stops always about 20% below the market open or something like that. Well, this penetrates the stops, sets off a limit order, your stock gets sold. It turns out, by the way, on the flash crash that for people who had stops, even though they reversed these trades that fell to a penny, they did not reverse the stop trades. And so if somebody had a stop that was 20% off the peak, it went down, it was triggered off, you sold the stock, you didn't get your money back, even though the price came back within 2 or 3 minutes. This is one of the reasons why, by the way, that when I make these occasional comments on Reddit, I say never use stops on anything. Have different ways to protect your trading, but never protect it with stops. They're also dangerous for other. Stops kind of lock you into trading at a loss a lot, because it only trades if you lose, and then it trades, and then it recovers. If you watch markets go up and down like this enough, and you say, well, why would it put a stop down there? Because what it's going to do is go down there, hit my stop, and then come back up, right? And so I'll be the only person that day that lost money. And that's literally true a lot of times. So I always say, don't use stops. Figure out a different way to protect yourself. Okay, now shopping for ETPs, you have to check this to make sure that you're getting an ETP or ETF actually that is safe to trade. Some advisors warn against using these instead of mutual funds. I kind of say you don't have it all in ETPs, or that's for sure. You should have really, your core investment really should be mutual funds. They're just safer if you're talking about your retirement account. No more than 60% of at least 60% of your money should be in mutual funds, because you won't have these kinds of problems. But to research an ETP, you have to see what they claim to track, and you have to be very careful about that, because it may seem that they're claiming to track the price of oil, when in fact all they're claiming to do is track the delta daily in the price of oil, which is an entirely different matter. Two, you have to see how it's collateralized. If it's collateralized with a direct market basket of an asset like an index fund, then it's just like a mutual fund. If it's collateralized by a portfolio that matches an index, same thing. But if it's collateralized with futures or other derivatives, it is not really suitable as a long-term investment vehicle, just generally across the board. I don't mean occasionally. I mean those aren't suitable. They won't track right. You don't use those for retirement funds. Then you ask yourself, does the NAV track the investment objective? In other words, if they say we're going to track the price of oil, if you map the NAV against the price of oil, as I do in these later slide examples, does it actually track it or not? And you'll multiple examples in Appendix B of the chapter where I show for fairly reputable funds, they just don't track it very accurately. Is the fund tracking the NAV, or is it premium or discount, and how much? And you say, well, didn't you just say that? No, this is a different issue. The first question is the NAV tracking what they state their investment objective to be? And the second one is effective, is the market price tracking the NAV? So there's two levels at which you can have error built in. The NAV isn't doing what they promised, or the market price is in fact trading at a premium or a discount to the NAV and is not tracking the NAV. That's a different issue. So you say, well, what does it matter if it averages out? And the answer is, if it averages out, it doesn't matter, but it's typically not going to average out. Funds that don't track usually track with a clear discount bias or premium bias. That is to say, if they're not on the NAV, they're either usually below it or usually above it. It's not as though there's mean reversion around the NAV. For some funds there is, but for most there's actually a bias, and the bias is mathematically explainable. In fact, the explanation is absolutely fascinating, but we don't get the explanation until we get to futures, because it's explainable by the mathematics of futures contracts, not the mathematics of ETPs. So we will come back to it. We will see the math. Then you'll understand it. And you'll say, oh, yeah, given that, the bias is actually unavoidable for some of these funds. Compare the fund for daily volume to compare similar funds, because if you have a low volume fund, that's a red flag. Because if the fund goes out of business, and thousands of these funds disappear every year, literally thousands of them disappear every year and are replaced by others, then usually it's kind of a rough exit if you're in that fund at the time it goes down. I gave an example years ago of a copper fund that gradually disappeared. The example is no longer relevant because it was a 10-year-old example, so I took it out, but it was pretty revealing for the time that I had it in here. Now, the shopping for ETPs checklist is described in more detail by the chapter, so you want to make sure that you kind of slow down and understand that. It's actually investment advice that you do need to understand. Okay, remember we started out and said dog goes down and the Dow goes up? Or others go down by twice as much? How in the devil do you do that? How do you get an inverse fund? That's a fund that goes opposite. How do you get leverage, like 2 to 1? And how do you get what is called a delta? A delta fund, again, is a fund that promises to track the daily change of the collateralized asset and nothing else. Almost all of the energy funds, like USO for US oil and UNG for natural gas, are delta funds. They promise to track the change in the daily price of crude oil in the case of USO. So you said, well, if it's tracking the change, isn't that the same thing as just tracking the price? No, because there's error. And the error is usually consistently biased, and over time the error accumulates to such a degree that indeed it's not really tracking the price of the commodity in question at all. Now, here's USO that we're looking at, and USO is a delta fund. It promises to track the daily change in the price of crude. And USO, we're looking at their asset holdings there. And let's see what they say about themselves. The investment objective of USO is for changes in percentage terms of its unit's net asset value to reflect the change in percentage terms of the spot price of light sweet crude oil delivered to Cushing, Oklahoma, less their expenses. So they're saying we're tracking the daily change in the spot price, and we're not tracking anything else. They invest primarily in listed crude oil futures contracts and other related futures, and invest in forward and swap contracts, although you don't do swaps right now. I'll explain swaps later. So when we look at their October 8th, 2019 holdings, it consists basically of one thing. It consists of a crude oil futures contract that expires in November 2019. They have 24,000 of those, and that has a market value of $1,303,645,100. And they have liquid assets like cash and T-bills of about the same amount. Now, what's going to be interesting about this fund, when we look at it, we say, remember, the fund's NAV is equal to the value of its assets divided into its number of shares outstanding. You look at this and say, well, this fund's assets, therefore, must consist of about $2.7 billion. This fund's assets, to determine the NAV, consists of $1.447 billion. This fund's assets are its cash. A futures contract is not a financial asset and has no value, as we'll see. That's going to be a very complicating factor when we explore the tracking issues of these kinds of funds. Right now, I'm just telling you that's ahead of us. This fund's assets are $1.4 trillion. It's also the case that I have very large positions currently in the British pound that I'm short. Those positions are very profitable as of today. I purchased almost $100,000 short of British pounds on Friday. And how much? And I had, I think, $67,000 or $68,000 cash in the account. So when I purchased $100,000 worth of those funds, what happened to the value of the cash in the account? It was completely unaffected. I started with $68,000. I ended, by the end of the day, with $68,000 because those contracts that I own are not assets. They are tracking devices that change the cash in my account, as we'll see when we get to futures. That's what's going to complicate the evaluation of ETPs a lot. And that's where the warning about you can't just buy them thinking they all behave the same way is going to come from. Our first exposure to that is here in USO. But I can't explain it until we understand what futures contracts are. So here's a summary of those 4 questions. Is the ETP market price tracking the NAV? That is should say mark it price. Maybe I should change that now. No, if I change it now, my computer will probably explode. Mark it price, and I'll change it. Is the NAV in the market price tracking the target? And do you understand the target? How is it collateralized? And what are the fees associated with long-term ownership of this ETP? The fees on these are very competitive typically, though not much of an issue. Okay. Now, this is the one we want to look at. The hack, as you can see, and here's some of the holdings there: Cisco, Splunk, Palo Alto Networks. I don't even know what CACI is, but see that 4704JP? That's a Tokyo market listing of some kind. That's one of the Tokyo stocks and the like. So, as is a couple of others down the screen here. So the cybersecurity fund hack is the one that I was talking about that might have been traded by this company. And it consists of these stocks, some of which are in overseas market. There's another ETF that you might find interesting called Gamer, which is tracks gaming stocks. It's doing very poorly this year because gaming stocks in general are doing poorly. This one, in fact, isn't doing all that well either right now. Very crowded market. Okay, so that's the one that we use as an example in the chapter, and I'm just introducing it here. Now, to sort of jump ahead a little bit, I've already said to you that the ETNs don't track well because they're held in futures contracts. I haven't explained why. But to motivate that explanation, I'm going to show you some of the worst investments out there that you could have made in the past that have this problem. These are the VIX exchange-traded notes, all of which you lose copious amounts of money on, all of which you're liable to use every penny you invest in them if you don't know what you're doing, because they have this tracking problem. Now, what they track is the VIX itself, and the VIX is an index designed to measure the volatility of the S&P 500. And I play the VIX very heavily. My SPY trades are mostly VIX related, except that I calculate my own version of the VIX rather than use the officially calculated version. But my own version is correlated very heavily with the calculated version, except when I see the number of the one I'm calculating, the number actually has a meaning. That is, its value actually has a meaning, whereas the VIX index is merely an index. So you can see that this goes up and down. Now, the current trade that I'm using qualified. See, the VIX is over here on the black chart. Well, first of all, the white chart shows its historical history. And during the crash, the VIX rose to values of 85 or so. And generally, when the stock market is doing really poorly, the VIX goes straight up. And when the stock market recovers, it comes back down to its normal trading range, which these days seems to be between about 12 and 22. And you can see that the black one, which is only a few days there, is 1 week's worth. We've got trades that run between, I can't even read it. It looks like 1650 and 2150. So that's actually narrower than the range it often is in. And generally I do my straddles when the VIX is down around 12 or 13. And I get out of them when I make money. I don't pay attention to what the VIX is when I get out. But generally what happens on a option, as we'll see later on, if you buy it when the volatility is low, when the VIX is low, when the volatility rises, the options balloon up in value. And that's when I sell them. And both sides balloon up in value. It's a non-directional bet. It doesn't matter whether the market's going up or going down. If the volatility is rising, your options rise in value. If volatility is falling, your options fall in value, independent of whether it's going up or down. Now, so many people play the VIX in one form or the other. A lot of mudders play the VIX. I get emails all the time from the VIX traders. The VIX, however, there's two of them here. The TVIX is the green and the VIX is the blue. Now there you see an example. This goes from 2009 to 2015. We can't use Yahoo data to bring this up to date because of how they changed the way they did the adjustment on the data. So we have to use old data for this and can't use current data. If you unadjust for the TVIX, then its high will show on old style unadjusted data as $2,500,000 per share. And the TVIX currently trades for about $3 per share. And you say, well, how is it possible that it's listed for $2,500,000 per share? Because it reverse stock splits 20 to 1 about every 2 months. That's why. And you can see it down here. You can see where it's reverse splitting. Well, actually, the next slide shows where it's reverse splitting. But you can see it's not tracking. You can see that the blue VIX is volatile, and you can see that it's got a slight downward trend. But you can see, in contrast to that, the green VIX has a savage downward trend. That's because this ETN has a huge negative bias on the price tracking the NAV, and it's mathematically explainable, but not now. So basically, if you didn't know this and went into this for an investment, you would be buying long in an ETP that is guaranteed to lose about 20% of its value per month, no matter what the VIX is doing. Guaranteed to lose about 20% of its value per month because of the tracking problem. Now, the VXX is the life of the ETN. The price shown is adjusted close, which means they had a reverse split many number of times, and here are the actual reverse splits in this time span right here. So the unadjusted close price is green, the adjusted close price is green, and the unadjusted close price is red. So it plunges in value, then they reverse split it. Then it plunges in value, and they reverse split it. And so in 2010, 1 for 4, in 2012, 1 for 6, in 2013, 1 for 6. They continue to do this, reverse splitting it every couple of years or so. And it puts the stock back up to about 60, and then it eventually goes to 0. And they reverse split it again. Even though what it's tracking is the VIX, which has a mean reversion property around 22 that consistently matches that property. And it's because of leakage that we'll be able to show you how it works from the futures contracts in the VIX. And so that's why you stay away from these things. Now, this is an extreme example, but this is a real example. This thing actually trades out there today. I didn't make this up, and this data, it hasn't stopped doing this. Anyone who trades these knows that this is how this one behaves. So how long are you in VXX? 15 minutes, 20 minutes at the most, you know. Maybe overnight, probably not. I don't know if anyone ever holds this overnight. I don't. I don't trade this. I just trade the stocks themselves. So this gives us a warning, given that that has not disappeared, that has a reverse stock split habitually. It behaves like this all the time, and people trade it. Indicates, well, there's something we need to know about then, so that we make sure we don't accidentally take a long-term long bet in a stock that behaves like this. And so the first rule of thumb will be, don't invest in anything involving futures accounts, and it won't be a problem, because that's why we're going to have this behavior. Now, I do end this by saying that we want to remember that these do pay dividends. of course. And so that really adds to it. So here's an announcement from about a year ago that I just happened to catch on the day the announcement was made. In addition to having a well-behaved stock, like SPY, then on top of that, you get every now and then, every quarter or so, about 55 cents per share for the stock you own. And so you get this monthly distribution. And so normally this is actually distributed to your account as a dividend payout. My wife has a bunch of these. And so you can break your account down and say, I just want to see the cash flow associated with, and then check dividends. And so we look at our dividend only on your account. It's all these little, $40, $80, $300, $20, $65, $80, $40, on down, time and time again, because she has a lot of these that pay dividends, and it adds up. It really substantially increases the yield, especially at times like this. So I think with the chapter and with this, you have enough information to understand that the real message on ETPs is they are like mutual funds, but with advantages over mutual funds because of the way they trade and with their liquidity. But some of them are, in fact, quite a few of them are actually the kinds of investments you have to stay away from unless you know exactly what you're doing. I generally say to people, unless you trade futures, you should never trade an ETP that includes futures in its collateral. And if you trade futures, then you know a lot more than the average investor knows, because futures are complicated contracts. Now, futures, unfortunately, are not what we look at next. We can't go any further without looking at bonds and bond yields and interest rate behavior. And so we'll take a look at that next as kind of a diversion, because we were already talking about tilt and tilt's behavior. And I said to you, interest rates move inverse to the market values of these assets move inverse to interest rates. We need to demonstrate why that's true. We need to set up a math model that demonstrates why that's true, and a model that actually has predictive value for bonds. If you know where interest rates are going to go, you know where bond values are going to go. Unfortunately, these days, nobody knows where interest rates are going to go. You used to be able, as I said, to rely upon central bank policy for part of that, but now that's broken down with apparently divine intervention. And sort of like Alice in Wonderland, what is up is down, and what is black is white, and a few other things are reversed. And until we figure out exactly how that's working, then absolutely nothing right now is predictable. Again, your assignment is to go watch the Trump Kingsman video, and you can see what state American politics has sunk to. Oh, I need to ask you a question. I had intended to speak a little bit about the Linux issues and the free open source software. I brought up the E.B. Neiman. This right here is the symbol for FOSS, which is free open source software, which has been around since 1975. It's a red feather, and the name of their primary product is the primary server out there, which is Apache 2.0. Most servers on Linux are running Apache as a web server. And so the big question arising is this an example of cultural appropriation, which is kind of a borderline question. I think, a case can be made no, a case can be made yes, but it has surfaced now in the, uncomfortably, I might add, in the free and open source community. Does FOSS and does Apache need to change their imagery to something that's more consistent with modern attitude or not? I would be interested in your opinions about that. If you don't know what Apache is, go look it up. And like I say, half of all servers out there running Apache. So it's free and open source. Yes.